We've seen obviously this completely unnerved markets with many falling into correction, having fallen more than 10% since their peak in mid-February. So, Robert, just in the past session and today, we're seeing a slight recovery. Way too early to see whether this is a significant turnaround. How do you feel as though investors can navigate what we're seeing right now?
Yeah, these are particularly unsettling for investors. It's really a natural part of long-term investing. Investors who remain patient and committed to their strategies tend to benefit over time. Look, drawdowns, while sometimes sharp, have historically been followed by recoveries. And the S&P 500 showed some resilience last Friday, posting one of its best days of 2025. It was up 1.8%. This really enforces the importance of staying invested rather than reacting emotionally to market downturns. Long-term growth tends to remains intact at around 11% per annum. So really, market corrections are temporary and history shows resilience over time.
So, what are you looking at, I guess, particularly in the data that's coming up that may well give an indication of where the market is going? Particularly, I guess, you take a look at the VIX and where that's sitting at the moment.
Yeah, look, taking a step back, long-term fundamentals remain sound. Corporate earnings are and consumer balance sheets remain intact. We are expected to see the US GDP come in at 2.5% over 2025. Unemployment data is still looking pretty strong in terms of it's a low rate. Last week, we saw inflation come in at slower than expected at 0.2%. So again, they're positives. We're seeing some more interest rate cuts priced into the market last week as well. In terms of, what are we monitoring? What we call kind of forward-looking measures, such as the consumer and business sentiment measures and the cycle. They really remain key areas for us to look at. And, a downturn in these indicators could adversely impact consumption, GDP growth, and unemployment rates.
So in terms of positioning then for your portfolio, are you taking a more defensive stance, or are you seeing perhaps some opportunity now given where the market's fallen to?
Yeah, we haven't changed our positioning. We do sort of maintain, quite a diversified all-weather approach to our portfolios. And that basically means having exposures to the asset classes that will do well in up markets, but also we've got exposures to certain asset classes that will also capture or avoid some of the down market as well. I think the key thing in this market at the moment is just really not being over diversified in some styles that did particularly well in the last couple of years. Your growth, exposure in particular. We've got some of that exposure, but we're not overly exposed to that one particular style of investing.
So you talk about those asset classes. So which ones are you liking right now then?
Look, I think still small caps and mid cap sectors are still very well priced. I think from an earnings growth perspective, there's some potential there compared to large caps. And they tend to benefit more from rate cuts historically. So we still like those areas. And we've got plenty of exposure to those areas across both domestic and international small and mid caps.
What about regionally? Where are you actually mostly invested at the moment?
We've got an overweight to international. Our managers, the exposure via the managers have been increasing exposure to Europe at the margins, but at the same time, there's been some value shown in some of those stocks there. So we've been overweight international relative to domestic, and that's a position that we've maintained through this sort of recent cycle.
So what's your view domestically, at least, of where the Aussie economy is tracking and how that's likely to impact or influence at least those earnings corporate-wise locally?
Yeah, we still like Australia in terms of exposure. If you look at sort of the international or the US relative to Australia, earnings expectations are considerably higher internationally. In the US, we're sort of expecting a 10% year-on-year growth rate for earnings this year. Whereas in Australia, it's probably fairly flat. Also, on a macroeconomic level, we still believe that, from a macro perspective, the US and Europe probably have more upside potential relative to Australia. So we still favour international over domestic. However, we still feel like there's good reason to have domestic stocks in the portfolio as well.
Robert, good to get across what you're seeing right now. Thanks for joining us from Activam Group.
Thanks for having me.